Hello, welcome to today's webinar hosted by Spheria Asset Management. My name is Gerald Williston and I'm a Director of Distribution at Pinnacle Investment Management, who are an equity partner and provide non-investment related services to Spheria. Today's webinar will be focusing on Spheria's Global Microcap Fund, the newest offering from the Spheria team. Presenting is Portfolio Manager of the Global Microcap Fund, Gino Rossi, and Marcus Burns, one of the founders of Spheria and investment chair for the Global Microcap Fund, who together have close to 40 years experience in investment markets. In March 2019, Spheria launched the Global Microcap Fund, confident this largely unexplored segment of the market presented the greatest opportunity for client wealth creation. The fund is an actively managed portfolio investing in a broad range of global microcap companies with the objective of specifically seeking out companies where the present value of future free cash flows can be ascertained and the security is trading at a discount to its intrinsic value. Recently, the fund has delivered exceptional relative returns in a period of extreme volatility by a carefully constructed portfolio of solid businesses with strong free cash flow generation and good balance sheets. Please enjoy the webinar and insights on a unique asset class with superior growth prospects. Over to you, Gino and Marcus.
Thanks, Gerald. It's Marcus Burns here, one of the co-founders and the investment chair on the Global Microcap Fund. Just want to give you a quick overview of the business. Spheria was set up in April 2016 as a small microcap specialist in the Australian and New Zealand markets for Aussie equities. And since then, we've managed to grow FUM to close to 1.1 billion. The business is profitable, well capitalized. And we'd always planned eventually to do a fund that looked globally because we thought that the strategy we were employing domestically could be applied internationally successfully. The team combined domestically and internationally has over 100 years of experience. And we think that is one of the key differentiators between how we operate and some of our peers. We've got a lot of experience, both domestically and internationally, which we bring to this product. And finally, the business is profitable and well capitalized, and that enables us to invest in resources to develop this fund. The team on page 3 is myself as investment chair, but the portfolio is actually led and run by Gino Rossi, who's got 20 years funds management experience, including a stint running Arnhem Capital, where he looked at international funds, joined by 2 analysts, Jeremy Lindsay and Amy Jordan, who joined within the last 12 months to help do research and help model stocks. And finally, we have 2 traders, Adam Lund and Alistair Doki, both of whom have got lots of experience trading domestic and international funds, who round out the team and provide the trading and liquidity provisions for the funds.
Thanks, Marcus. It's Gino Rossi here. As Gerald mentioned, we launched a product in March last year. However, the product was in development for some time and really was about scoping out whether a microcap product made sense, because we noticed that very few fund managers offer the product, not only in Australia, but globally. And the more we looked at the microcap space, the more excited we got. We think that's the best opportunity to add alpha for clients and does have the potential for better long-term growth. We think a lot of managers overlook the space because it is a relatively difficult space to run. You're not getting a lot of support from the investment banks in terms of research, so you do have to invest heavily in your own dedicated research team. There's travel, obviously. And then the fund can only be so big in microcaps. You're not going to run a $50 billion fund. It's only ever going to be 1 or 2 billion at most. And so for many large fund managers, that doesn't really stack up. But for a boutique such as ours, with a focus on small and micro, it does make sense, and we are excited about the space. This slide shows the long run return of the microcaps over a long time frame. So on the left there, the US since 1926, and on the right, UK since 1955. You can see this data shows microcaps have been the best performing segment in the market over the long run. I think you would expect that. Companies lower down the market cap spectrum are more nimble. They're growing off a lower base. Typically, we see very high levels of management ownership and the founders still involved. And of course, the other thing is they're often acquisition targets, which helps supercharge returns. Next chart shows what I'd call some microcap graduates. So I think quite a few of these names are familiar to people, but what they have in common is that they all traded publicly with a market cap of less than US 1 billion. So just to give you some examples, you can see Monster at the top left is a leading energy drinks maker. The Coca-Cola company took a large stake in that a little while back. Illumina is the undisputed leader in genetic sequencing machines. Likewise, Roche tried to take the business over and was unsuccessful. Activision is one of the leaders in PC gaming with names such as World of Warcraft and Call of Duty. And you can see Netflix, which I'm very familiar with at the moment, given COVID. And the advantage our fund has is we do not have to sell businesses just because they're no longer microcaps. We can continue to own them. And you know, Marcus and I have found over our careers that often you'll see these companies, and as they grow and get bigger, management access is harder. They tend to clamp up, they get these big IR teams and they don't disclose as much information. So that knowledge you get in the early days is really valuable, and we feel we can understand these businesses better than anyone else getting in early. And often, you know, management teams will remember the fund managers that back them early and will always take the time to speak to them. So again, we think it's another advantage of getting in at such an early stage.
I think just to add something to that, I think Gino's point is right. These small and microcap companies globally have a longer runway than you'd find domestically. If you have Netflix, for example, which obviously started its business originally in the US as a DVD rental business, I believe, and then switched to online rentals. It's grown from its domestic market, which is obviously a very large market compared to Australia and New Zealand, but it's grown internationally through Europe, through Asia Pac, and is, you know, getting subscribers in many geographies. Equinix, which is a data center provider, similarly started in the US and has expanded internationally. So the runway that these stocks get is significantly greater than if you're trapped in a local economy as a domestic stock. And that's something we look at and consider when we're scanning the universe for attractive stocks that might fit the profile of the portfolio.
Next slide is one thing that really attracted us, and that is the fact that in microcaps you're really flying under the radar. So you know, it's not uncommon for us to look at a stock. We bring it up on Bloomberg and we'll see there's no coverage, there's no recommendation from brokers, there's no broker report. And you see 42% of the index has no coverage at all in Bloomberg. And so that creates a very high barrier to entry, because either if an investor comes on, they're going to have to take a very unsophisticated approach, or they're going to invest in their own infrastructure, their own analysts. So there's just fewer people playing in the space. Whereas you look at the S&P 500 at the right there, and on average there's 22 recommendations on Bloomberg. And there's no companies in the S&P 500 that do not have any coverage at all.
And it does make sense. Just to harp on a point, it does make sense. Large companies can afford, well, the trading in large companies is much bigger, much more liquid. There's more shares traded, there's more commission generated for brokers, so they can afford to have the coverage on the universe. As you go down the spectrum, clearly the market cap and the amount traded per stock decreases dramatically, and it just doesn't become economic for broking businesses or broking firms to set up with a whole bunch of analysts covering stocks. And that's really where the opportunity for us is. We come in as an organized team with great product, a great system, scrub down the companies, and to Gino's point, we get very good access to management teams, which means we get incredibly good insights into how they're operating and how they think about their business, which often doesn't happen as you go up the spectrum and try to deal with larger companies. And that's something that really excites us as a good opportunity.
Next slide looks at microcaps coming out of the GFC. But one thing we noticed that over the long run, yes, microcaps do better. But if you break it down into shorter periods, they tend to do particularly well in a pro-cyclical or an accelerating economy. And so, coming out of the GFC, you saw the top line being market caps perform the smalls and the large caps quite significantly. So they provide better leverage to recovery or to growth. And that's one thing we like as well. Relative to smalls, micros really do have their own rhythm. They do tend to perform a little bit differently to large caps, whereas smalls are more closely aligned to the way large caps perform. So we think it adds something to a portfolio. We think it better complements fixed income assets than other parts of the market cap structure. So in 2020 so far, I should add, market caps are very much stuck to script in that they have bounced harder off the March lows than smalls and large.
Just touching now on the investment process. What we decided to do here was take the process that we'd proven worked well domestically in Australia and New Zealand with Spheria and seek to reapply that globally. And the process has 3 or 4 key attributes to it, which are fairly simple to understand, but when you apply them, they really do sift out the wheat from the chaff and enable us to find companies that are strong, sound businesses with excellent cash flow. And so the things we look for really are businesses that can generate sustainable free cash flow through a cycle. Typically, these are companies with quite high returns on capital because there's not a massive need to reinvest a lot of capital in business for them to grow, and they spin off free cash. Secondly, as investors long term, we like to find businesses that have low gearing in their balance sheets. This provides lower risk for us and also gives the companies opportunities to use that balance sheet to re-leverage either by acquisition or share buybacks or to buy technology in adjacent areas. And of course, finally, we look at valuations. We do valuations on every stock we own in the portfolio. We build out models. We get as much data on the history of the companies as possible. In many cases, going back 20 years. Some of the newer companies don't have that history, but if we get as much information going back as long as we can to see how businesses trade through cycles, where margin pinch points are, what competitors can do to them over a cycle, and what the return on capital is through a period of time. And we're looking for businesses that we can find at attractive discounts to those long-term valuations. Thirdly, we keep an open mind. This is something that is easier where we find changes in management teams or strategies are much more pronounced on smaller companies. If you're a large company and there's a change in CEO, it's often many, many years for that behemoth to change direction, shed staff or right size or whatever is required to get the business to perform well. Smaller companies can change quite dramatically when there's a change in the top executive. They can shed underperforming assets, they can quickly divest or in fact invest in things that mean the business can turn around quite dramatically and valuations can quickly respond to that. So we try to keep an open mind and look at the facts, and if they change, we change our view on the stock. And then finally, just to reiterate that point, we're dealing with, in microcaps and small companies in Australia, the universe is already huge, but if you spin that to a global marketplace, it's almost infinite. So there's approximately 14,000 shares globally that fit the microcap bill. That's market under US $1 billion. So 14,000 shares, there's no one who can possibly cover that. So we use a variety of screens from Bloomberg and other sources with a variety of metrics to pick up businesses that we think could look attractive. The team discusses those, and then we allocate them to analysts to model up, and then eventually contact the company for follow-up phone calls. So there's quite a lot of history done quite a lot of work done on the company before we even speak to the management teams, all looking to see whether the fundamentals we're digging up confirm the 3 or 4 things we're looking for in business: that free cash flow, low gearing, and obviously what we think it's worth in the medium term. On the next slide here, this is maybe a little bit technical, but all we're trying to show here is that what Spheria has so far found and built the portfolio. There's roughly 45, 46 stocks in the portfolio, so it's relatively concentrated compared to some of our peers. But compared to the index, which is a global microcap index, the fund has found businesses that have, on balance, lower valuation. So the EV to EBIT multiple, so the EV to earnings before interest and tax multiple is a bit lower than the index on the left-hand side there. The free cash flow yield is higher, not surprising given that's the core of what we're looking for with businesses. Dividend yield is a bit higher. And then the gearing, so the net debt to equity or net debt to EBITDA, for example, is lower. In fact, on balance, if you add up all the cash, most stocks we invest in have a net cash on the balance sheet, which means there's no actual net debt. Some stocks have a little bit of gearing, but on balance, the entire portfolio is effectively net cash. And then finally, the portion of companies that are profitable and generating cash is 98%. So everything's making cash flow. One business is in that startup phase, but likely to make money or free cash flow in the short term. The average capitalization for the stocks is about $600 million. So they're not tiny little $50 million, $10 million businesses. These are $600 million US market caps, almost $1 billion of Australian market cap in terms of market size. So they're quite established, have proven their business models, and already represent, in our opinion, a very sound proposition. And we think they've typically proven themselves in a niche domestically, starting to move into adjacent countries. And that is really the time that we find getting on board as a really attractive risk-reward payoff for investors.
Thanks, Marcus. Let's go through 2 investment examples to give you a better feel for how we look at stocks. Before I dive in, though, I just want to explain that chart on the left. So for those familiar with Spheria, they would have seen this chart many times. It's key to what we do. And really, it's a shorthand version of what we do in more depth. But this chart compares the free cash flow, the dark bar, to EBITDA, so the profit and loss, the P&L accounting profit. And this is real shorthand for achieving two things. Number one is a great accounting check. So, is the profit reported in the P&L actually coming through in the cash flow? Are the earnings being made up by management assumptions, or is actually cash being collected from customers? And secondly, it really goes to what Spheria is all about, which is focusing on companies that give off free cash flow to shareholders. We don't want companies that are forever having to tip money back into the business to grow, forever having their hand out for more money from shareholders, because ultimately, when are we ever going to get paid for that as shareholders? And secondly, those sorts of companies can run into problems, because if the share market does shut or the share price does fall, then they're in a bit of a quandary in that either they have to get diluted heavily to raise more equity, or they have to wave goodbye to that growth. So we think by avoiding those sorts of companies, we also avoid some real big downside scenarios. So we always look at this metric before we look at a stock. As I said, it's a shorthand. There's more to it than that, but it's something we really focus on, and you'll see it a lot in Spheria presentations. So the first stock I want to talk about is MIPS. So MIPS is listed in Sweden, and they are a owner of a patent for a brain protection system. So as you can see in the top right, their protection system sits within a helmet. And what's designed to do is deflect rotational motion. So in a normal helmet test, they drop a helmet vertically in a straight line down onto a hard surface and measure whether the helmet is robust and safe enough or meets the standards. The problem is, in the real world, you may fall at an angle, you may hit an object at an angle, and this will introduce rotational motion, which, if strong enough, can tear the brain tissue. So what this MIPS device does is it deflects, so it moves ever so slightly within the helmet and deflects that rotational motion away from the brain. Very much the same way your brain sits within the skull, and the cerebrospinal fluid does the same thing, allows the brain to move ever so slightly within the skull, deflecting that force. So really ingenious, it's patented, and what MIPS do is they sell this technology to other helmet manufacturers in what is termed an ingredient brand. And what we like about this concept is we see winners all along the value chain. So MIPS make the device for approximately $1.50. They then sell it to the helmet manufacturers for $5, so making a very tidy gross margin. And then at the retail level, you notice about a $20 difference between a helmet with MIPS and a helmet without MIPS. So again, for the retailer, for the manufacturer of the helmet, they've got about $15 to play with, which is considerable. And then from our point of view, the consumer's paying an extra $20 for a potentially life-saving piece of technology. So all along, from the consumer, the manufacturer of the helmet, the retailer, and then MIPS as shareholders, everyone is winning along this value chain. So we like the sustainability of this business. MIPS is it's already has a relationship with most of the bicycle helmet manufacturers, but where there's tremendous growth is in moto, so motorcycle helmets. They're already quite strong in motocross, but in motorcycle helmets. There's also a big opportunity in military and construction helmets. And when you look at the cash flow that this thing spits off, and the very high returns, we think there's still upside in this stock. So we think it's a great long-term growth business. One we remain very excited about.
It's a good run through, and Gino, you might want to give listeners an example that it works. Gino managed to unfortunately come off his bike a few weeks back and suffer a bit of potential rotational issue to his head. So the MIPS helmet does seem to work, and is a very functioning device, thankfully, or else Gino might not be in such good shape as he is today. Just moving on to Sonos, which is another example of one of the bigger holdings of the fund. Many of you will be probably familiar with Sonos, which is produces wireless speakers and wireless sound systems for homes. Sonos was IPO'd about 2 or 3 years ago, and has and effectively does tick our bill. So you can see that the chart on the left-hand side that Gino flagged earlier, free cash flow conversion chart. It's been losing a bit of money historically because it's been investing very heavily in both R&D and sales and marketing. There was a change in management team approximately 12 to 18 months ago, And the new team has come on board and recognised they were possibly spending some sales and marketing dollars inefficiently. So it's reallocated that to more online and less offline, and then they kept the foot very heavily down on the R&D. Now, the reason we like this business is it started to generate free cash. Return on capital is very high. It's got no gearing. It's got a net cash balance sheet of over $250 million on the balance sheet with no debt. And it was the founder and creator of Wi-Fi speakers. So it's got technology patents going way back, covering a myriad of Wi-Fi for speakers. You often find the smaller, cheaper ones are Bluetooth, but the Wi-Fi gives you a much better network, much higher quality. And because of the operating system that Sonos puts across the system, it's upgradable and much more flexible than most other systems, and hence the reason it's an incredibly good proposition for consumers. The other thing we like about Sonos is it's additive and it has a bit of a network effect. So once you've bought one speaker, the app allows you to drive zones and control speakers so efficiently and easily that people do add to it. So they will bolt on ceiling speakers or speakers for outside or different rooms, different zones, etc. And so it has an incredibly good retention rate for existing customers. So something like 37% of current sales are made to existing customers, which is also very impressive and much different to many other hardware makers. And finally, we think that it does actually tick an ESG box as well. So the product is very well made, very robust. Something in the order of 92% of products ever made by Sonos in its 20-year history are still in operation, which is an incredible feat for any hardware manufacturer. And there was a bit of a brouhaha as they tried to recently update their operating system, because some of the older systems are very small, have got small memory, and it's very hard to upgrade the software. But what they've done is separate the new and the old system, allowing people to continue to operate them for as long as they're actually feasibly possible. And then finally, we do like the fact that it's actually over half of the R&D engineers are software, not hardware. And we think there's a real opportunity medium term for them to monetize Sonos as a system, or Sonos as a platform to other hardware makers of speakers and sound systems. And lastly, like many other small companies that Gino touched on earlier, it's a possible acquisition target. It would fit very nicely in with other large tech players. It's only going to mark up just over $1 billion. And with its growth dynamics and cash flow dynamics, it would be a very attractive target for somebody looking to expand into a leader in this space.
Thanks, Marcus. Do you want to touch on the performance?
Yeah, I think just both of us can touch on this. The performance has been incredibly strong since the fund was launched. So the fund has been up since the 1st of March 2019. There was a paper portfolio run from mid-December 2018. So there's 3 or 4 months of paper performance, and then from about a year and 2 months ago, we've been running a real portfolio, and the returns have been pretty strong. I think what we're proud of is not only are the returns strong, but they've been derived in a very broad sense. So there's 46 stocks in the fund. We do track, obviously we do try to invest in a low risk fashion. So what is pleasing for us is the beta, or the amount the fund wobbles around compared to the market, is lower than the marketplace. So is the volatility. So those sort of backward looking risk metrics, which people commonly look at, are lower than the marketplace, and yet the returns are materially higher. So we haven't taken an undue risk to get those returns. As I said, the fund has 46 stocks in it, and the biggest position is about 3.5% to 4% in the fund. So modest risk, and the alpha generation has been taken and earned across a variety of stocks and a variety of sectors. And so I think what's attractive about the fund, not only are we getting on the grounds with many of these names, but the fact that the stocks are global means that we are finding great diversity across sector, across geography, across currency, and that is a really attractive proposition for this asset class, we feel, as long as to the fact that it's very under-researched, thus providing small, nimble teams like ours with incredibly good opportunities.
Yeah, and I think what's pleasing is during March, those Spheria characteristics really came to the fore, and that low gearing and good cash flow was really valued in times like that. You can see the 3-month performance is relatively good compared to the index. It's a chart showing that the long-term performance, again, just I guess showing you that, again, what's pleasing is that the fund did quite well when the market was strong, was also able to do relatively well in times of weakness.
Just explaining, so the dark blue line there is the Spheria fund performance. The light grey line is a benchmark, and you can see, as Gino pointed out, in March, when in late February, early March, when the market dislocated and fell quite dramatically, the fund had material outperformance. So it outperformed by about 9%. over that period of time. Market was down 20 odd, we were down probably 10, and then we bounced out of that down performance. So over the last 12 months, the fund's actually performed up, we're up, and the market's actually down. So a very strong result, but not taken with undue, narrow bets.
Next chart's just talking through our top 5. Again, trying to give you a sense of how we think about stocks. So Sonos, obviously, we've covered. The second largest holding is Pole to Win. It's a Japanese company, very strong position in a niche, and that niche being testing of gaming software. So you can imagine everyone locked in their homes, mobile games and the like are very popular at present. But before they go out, all the bugs need to get taken, and that's where Pole to Win comes in. Between them and another competitor in Japan, they pretty much sew up that market. So real Spheria characteristics, cash flow is very good, net cash, and a very nice industry structure there. Stock is a leading beverage company. Although it's based in the UK, its biggest markets are Poland, Czech, and to a lesser extent Italy. And we think this is being overlooked by the market. Some very strong brands, very strong position, and good value, growing nicely with a good balance sheet as well. So we think the market's just overlooking the potential here. We see good value. Fieldcraft is a Norwegian electricity retailer. What's nice about this business is you're seeing some very positive regulatory tailwinds in Norway, and Fieldcraft's very well positioned to grow and also consolidate the industry there. Johnson Outdoors, do you want to touch on Johnson, Marcus?
Yeah, Johnson Outdoors is a US-based business, and it has a leading outdoor position in fish finders. So it owns a brand Humminbird, which is if you're a fishy or a boat owner like I am, small boat owner, I hasten to add, a bit like the fund, microcap boat. It's a leading producer of Humminbird, which you can use for finding fish and directing boats. It has GPS built in, etc. Very high market share there. All produced in America, and then has some other outdoor products like canoes and camping and scuba gear, which to a lesser extent is not as important, but that's a very strong business, great return on capital, family controlled, and has been growing and taking market share for many years. So again, like that, modest valuation, incredibly good balance sheet, incredibly good cash flow generation, conservatively run. And so you get a good sense there that we're not just US centric or European. There's a good smattering of stocks and ideas coming from a variety of industries and a variety of locations, and you can get a sense of how concentrated portfolio is or otherwise by the holdings on the right hand side there.
Thank you, Gino and Marcus. That was very insightful, that presentation. Just in closing, the Global Microcap Fund, it's really a unique asset class that we consider have superior growth prospects looking out. As we discussed earlier in the presentation, it is an under-researched area with better access to management teams. And what we are doing is Spheria as a team are taking their proven small and microcap process that they've had within the domestic marketplace for a long period of time and applying that globally. So in closing, Gino, Marcus and I would like to thank you all for taking the time to listen to this webinar. We do genuinely appreciate you spending the time with us today, and we are also generally excited about the fund, this unique asset class and opportunity set. If you're interested in learning more about the Spheria Global Microcap Fund, please get in contact with the Pinnacle Distribution team. We would be delighted to help. Thank you.